When you see a 500-point drop, a ferocious attempt at a comeback, and then kind of a failure, I guarantee it's a little bit of a market jitter. You call it post-traumatic volatility disorder. What does that mean?
Yes, I mean, what we are seeing from markets right now is an inherent fragility. Volatility remains high. Investors are shooting first and asking later. And in response to a lot of comments coming out of companies, none of them overly concerning in and of themselves, but nevertheless, investors are looking at them and saying, I'd rather just take down my risk right now, and I will reassess what these issues are.
Well, what's changed? I mean, for the better part of the last 12 to 18 months, the market was kind of an old dog, right? I mean, just kind of walked around every day, went up, was fine. All of a sudden, it started running around the house wildly barking. What has happened to this market?
I actually agree with you. I mean, the concerns that people are citing now are the same concerns that we've seen at the beginning of the year. And when we look at the earnings backdrop coming out of corporations, we have their comments. Yes, some of them people are gravitating towards, but by and large, the results so far have been pretty spectacular. The breadth of companies beating is very strong, 75%. The amount they're beating by is right in line with historical averages. So to your point, there's not really enough there to warrant the sell-off that we're seeing.
Although you know better than I do, Patrick, but I mean, the earnings numbers are the rearview mirror. We're looking out of the windshield, and I think it's clear the market is seeing some bumps in the road.
Well, I mean, on a corporate profit backdrop, as I look out the front of the car, you know, we're seeing digits that are 18, 19% for 4Q. Growth remains sufficiently strong in 2019. So we aren't seeing a precipitous decline.
You've been happy with the guidance, then, that you have heard?
Well, even out of the guidance, we're talking about several individual companies in aggregate, and we've seen just really industrial companies report so far, but in aggregate, the trends aren't deteriorating. Technology companies report this week. They are a huge portion of the market, have been driving tremendous success over the past several years. We expect them to help investors re-anchor around the underlying strength.
Yeah, what's more important? Is it the technology companies merely because of their weight? They matter literally, they're the big lifters, or is it the financial companies because maybe they provide us a window into the consumer and the economy vis-a-vis commercial loans and borrowing activity? What will be the more important group to watch?
Well, I would advise investors to focus more on technology. To your point, they are a bigger weight, but the results have actually been so strong, and the business trends in those companies are very successful. Financials, we've already really seen results out of them. They were actually pretty good. Economic trends, yes, they are a little bit weaker. Lending remains a little bit weaker, but it's not matching the precipitous decline that we are seeing in the equity market currently.
Okay, what do we do then? What's the advice? What's the best advice right now?
I mean, for investors that are looking out over the next 2 to 3 months, we are likely to get the sell-off back as volatility comes in. As investors realize that the corporate backdrop remains intact, we aren't seeing recessionary risk on the horizon. Absent recessionary risk, you want to be invested in the market.
When you say sell-off back, you mean regain what we have lost?
Regain what we have lost,
So you believe
yes.
we'll kind of, I hate to use the term Santa Claus rally or holiday, whatever you, New Year's rally, you think we're going to get the market coming back a little bit?
You picked the holiday term, but that's absolutely true, yes.
Okay, and that's going to be because of, A, what you mentioned, the strong backdrop.
The strong backdrop, and really absent recessionary risk, which we do not see on the horizon, you want to be invested in equities. Corporations continue to sell goods, consumers continue to buy services. That is not going to change.
But all that you're saying, Patrick, and we hear you, brother, we hear you, but all that has been kind of the same the last few months, and all of a sudden the last 3 weeks, things have kind of gone a little bit haywire when the backdrop has remained fundamentally the same.
Yep, and I think it goes back to the fragility that investors are feeling right now. They are, like I said, shooting first and asking later, selling the positions that they deem to be high risk. People get uncomfortable with the same. They always look for something new, but for the most part, the same is good, and right now, the same is actually quite strong.
So stay calm, invest on.
Yes, absolutely.